Welcome back to Morning Movers. I'm Diane King Hall live from the floor of the New York Stock Exchange, where it is risk on Wall Street. For more, we want to welcome in Ted Thatcher. He's the president of Bright Lake Wealth Management, joining us here at the big board. So we're seeing a risk on kind of day, and this comes in the aftermath of what we hear over the weekend on the U.S. Between the U.S. and Iran reaching essentially what seems like finally a peace deal. We don't have the terms of the deal in front of us yet, but does this reaction on Wall Street make sense to you, Ted?
It does, Diane. I mean, honestly, obviously, so much has happened with the price of oil. We see oil futures down. Equity markets are going to like that. There's been a lot of course, consumer pressure with this war, and to see a light at the end of that tunnel is really important, especially as we head into the Fed chair week. You know, Kevin Warsh sitting down at the helm for the first time. I think that this kind of news makes his life a lot easier this week.
It makes it easier, but it's not going to be an immediate off-ramp. Yes, we're seeing oil prices come down right now as we sit around $80 a barrel for WTI. Brent crude also coming down, but it's not like a quick flip of the switch, essentially, to move the flow of oil.
No, it's, I mean, we've had a supply shock in the oil system. And, you know, one analogy I've heard a couple times is it's kind of like a bowling ball that has to move its way through the boa constrictor of the economy. We've been at this now for 4 months. I think, you know, even if under the best of terms, if we continue to see oil go down, it's still going to take at least another 2 months. I think the administration hopes probably we get to more stabilized oil prices, inflation metrics by the midterm time frame. So you're absolutely right. It's not a flip of a switch, but it is, you know, positive, I think, moving in the right direction. And that's why we see, you know, the markets green today, this morning.
And inflation has been stubborn, and we've seen an uptick, whether we're talking about CPI recently, PPI, numbers that you don't love to see. Obviously, a good portion of it has been energy, and PPI, they've kept that contained away from the consumer so far. But do you think there is some risk of us still seeing some hot inflation for a little while longer?
Certainly. I mean, I hope that the most of the inflation is behind us in terms of the push up, because, you know, we had that, you know, a couple weeks where we were at not just $100 a barrel, but 115, 120 at times. We came back down from there. We've sat in the 90s here. So I do believe the worst is behind us, but it wouldn't surprise me at all if it takes, again, quite a little bit of time here for that to work its way through the system. My concern really would be is if we started to see it filter through all of the core metrics. So far, it's been contained to the headline number, especially on the CPI and, PCE. But, of course, if it filtered down, that's where I would say, you know, consumers would be in more trouble.
What's the biggest worry of your clients?
You know, of course, consumers have been under pressure. Costs and inflation tend to be retirees' #1 concerns. You know, obviously, investors want growth and good upside, but especially, you know, the folks we work with being in the more retirement phase, they also want to make sure that, hey, their downside's protected, and they know they're going to be able to pay their bills month to month and keep things stable. And so definitely the pressure of inflation and costs is a huge concern.
What's the hedge that they are asking about?
You know, when it comes to, you know, risk mitigation, there's a lot of different strategies, you know, investors will use. I think fundamentally owning quality companies, that quality valuations really gives investors a lot of, safety through diversification. And so fundamentally, those are the types of things we look at when we think about a hedge, especially for the retail investor.
And then when you think about risk assets, obviously we're seeing tech off to the races once again, with the off-ramp seeming to come sooner rather than later for the U.S. and Iran. Is the tech sector still in a position that you like, and does this make sense to you?
You know, I think there is a discussion these days about whether or not we kind of come out of this rally, again, with too high evaluations. When it comes to the big tech names and the mega cap names, really, I think it's about where we look. The truth is a name like NVIDIA, look at its forward earnings right now. It's trading at about 20 times forward earnings. That is near its 10-year low forward trading multiple. The low over the last 10 years is about 18.5 or so. So a name like that actually is really attractive to us. Same with Microsoft, trading at 21 times forward earnings, near its 200-week moving average, a nice technical indicator. And, you know, that's to say, you know, nothing of a name like Meta as well, which has gotten a little bit beat up in this marketplace. And in the AI economy, I think they're well positioned.
Well, the issue with Meta seems to be just, is the spending worth it, especially given how much they're spending. And NVIDIA, I wonder this, because I've heard numerous people make this point about NVIDIA, that it's been difficult to see it not moving with a lot of momentum. But at the same time, it's nearly a $5 trillion company. mean, I wonder if that's part of it. It's a heavyweight. It's hard to move a heavyweight.
It absolutely is. I mean, ultimately, NVIDIA's moves up, if they happen, really have to come with a re-rating of the company as a whole. You know, all of the hedge fund managers on Wall Street, if they have to take a short position, because it's the biggest name in the game, it's an easy, one to pick out. And so I think that has kind of kept some of the pressure on NVIDIA's valuation being lower than Jensen, of course, would like. But ultimately, over time, I'm really bullish on the company.
And then let me ask you, I want to go back to the point you made about Microsoft. So there's it got caught up in the SaaS apocalypse,
yep.
essentially. So in other words, you think Microsoft was unfairly caught up in that?
Yeah, Microsoft has been almost a victim of its own diversification, too, in terms of the verticals of their business. And fundamentally, yes, on the AI discussion, Wall Street's concerned about whether or not the per seat costs are going to come down because of the AI economy. I think that is maybe not properly underwriting the value that they actually have in distribution when it comes to the enterprise layer of business. Every business, of course, has Microsoft absolutely ingrained in it, it feels like. And when we see what we have coming out of Build, Microsoft's keynote, they talked all about how that's moving more and more on the agentic side. And I think it's fair to criticize Copilot and that release, but ultimately, I really believe in Microsoft's distribution, and I believe they're going to be a huge winner in the long run when it comes to the AI, especially in the business place.
You have a view that about AI potentially being a long-term disinflationary force. What do you think about portfolio positioning with that view in mind, then?
When we think about disinflation, obviously, I think, of course, first to the consumer side. And we have spent so much money in this economy, of course, building up the data centers, and we just haven't quite gotten the cost reductions yet that I believe will ultimately come. When we see the agent and, incredible thinking ability of these machines, when you start to think about what that means in terms of driving costs down and also productivity, I think it's easy to make a use case, if we fast forward into the future, that will drive down costs for consumers.
All right, Ted, we'll leave our conversation there for now. Thank you so much. Appreciate that. That's Ted Thatcher. He is the president of Bright Lake Wealth Management, joining us here at the Big Board.